Okay, let's look at environmental costing and remaining chapters in this section. After that, in next video, we will do questions from kit, BBP kit. So I will just skim through these chapters. Obviously, you have to read them in details. So I will just focus and explain important points here. Okay, so the first thing is they've explained the importance about environmental costs, why you need to know about environmental costs. There are many reasons behind it. One reason is that the public has become aware of the environment, so they would want a product that is environmentally friendly. Otherwise, they could boycott your product. And there is the cost involved. So obviously, if you are releasing waste into the environment, you will be spending more material, there will be more waste, so more loss, more will be the cost. So if we try to reduce, our cost will also be hidden. And also it is ethical. So when you are thinking about the environment, you're doing something ethical. And when business is doing something ethical, its image is positively affected. Okay, then they've explained here in the bottom the typical environmental costs that you have, means the costs that affect environment, consumable and raw material. If you are wasting your material, the cost of that material going into the environment, that would be environmental cost. Transport and travel. The cost of transporting waste to the location of disposal, or general transportation costs like cars are emitting carbon waste. You might have studied this in process costing in F2. The normal loss, which is called waste. So the more the waste, the more will be the cost. Waste and effluent disposal. So waste and effluent just means liquid, poisonous liquid that you're disposing maybe into the rivers and stuff. Water consumption. So if you're consuming water, what happens is that there is water deficiency in the region, and also because you're consuming water, obviously you will be paying for that. And then energy. So the more energy you use, like I saw somewhere in a documentary where it said use less electricity and save the environment. Because if you use the sources of electricity sometimes affect environment. So if we use less electricity, less energy, then environment will be positively affected. Okay, then we have environmental management accounting. F2 is management accounting, so environmental management accounting becomes specific environmental accounting. So it is generating an analysis of both financial and non-financial information in order to support internal environmental management process. So remember, in management accounting, it is not just the financial information, which is the money that has gone in the waste. It is also about non-financial information, the image, the ethics. Remember, non-financial information affects business in long term. So if you're affecting your business negatively, what will happen? The image of the business is affected negatively. What will happen in the future? People will slowly stop buying your product, so you will be affected in the long term. And then benefits of understanding environmental costs. Why is it important that we need to understand environmental costs? One reason is they could be very significant. The waste that is caused and then that goes to the environment, that waste could be a very huge amount. If we try to reduce that, the cost would be reduced by a huge margin. And then, because nowadays there is a huge concern about environmental costs, you might have seen about it in the news, maybe you have seen it in YouTube. There is a new setup started by a guy by the name of the Ocean Cleanup. So he has devised system for cleaning oceans and rivers. So there has been concern increasing day by day. Ethical issues. It is ethical to think about the environment, and most of the companies nowadays they put it in their product, like you've seen ISO and stuff. They're following their environmental guidelines, so there is something ethical. Improve brand image, like Tesla. One of the main reason it became that huge is because of thinking about environment and producing electric cars, reusable rockets. And another reason, if we are costing our product, if we take account of the environmental cost, what will happen is our product will be costed very accurately, because it will consider all the costs that it involves. Okay, defining environmental costs. So Hansen and Mendoza in 1999 suggested that environmental costs are divided in 4 categories. The first one is environmental prevention cost. It is the preventing waste to happen, for example, preventing that the environmental cost doesn't happen in the first place. Examples of these are forming environmental policies, performing site and feasibility studies, staff training, environmental detection costs. And then once we have caused the environment negatively, then detecting that would be detection costs. And then environmental internal failure costs are those costs that affect environment, and then we have to pay for that. A good example of this would be I will focus on this one, recycling. If you are doing waste, a lot of waste, and then you have to dispose that waste, and usually there is cost with the disposal. And then environmental external failure cost. It is the cost that is incurred by your organization, but others suffer it. Like they've given an example here, cleaning up, decommissioning and stuff, the landfills and stuff. Or like in Afghanistan, we have people, they have heaters and they use coal in it. So the neighbor suffers from that heater because all the smoke goes to the neighbor's house. Okay, conventional costs. This is another qualification which was published by the U.S. Environmental Protection Agency. So they also divided in 4 parts. One is conventional costs, the normal costs, like material and stuff that you will be using and they will be wasted, and because of that the cost will be incurred, like electricity, because you're consuming electricity. Electricity is made of something that affects the environment. Potentially hidden costs. Some costs are hidden in overheads. They are not specifically identified. So if we identify them, our product will be cost accurate, and then we will try to be able to reduce it. Contingent cost. Contingent costs are those costs that will be incurred because of negatively affecting the environment, like cleanup. So if you have waste, you have to have cleanup, or you have to dispose your waste. Image and relationship. So if you negatively affect your environment, the image of the business will be negatively affected. Okay, next, there are different way of accounting for environmental costs. One is input-output analysis. Input-output flow accounting. So in input-output flow accounting, what we say is we will look at the inputs that goes into the system, and then they are processed. Then we have finished goods, for example, 75%. We have scrap, 10%. So the remaining will be waste. So the lower the percentage of output or scrap, the higher the percentage of waste is going to be. So if we try to increase the positive products, what will happen is the waste would be reduced. And flow cost accounting says that environmental costing is divided in 3 categories: material, system, and system delivery and disposal. So first thing is we look at the material that we are using. Maybe that material that we are using by itself is something that affects environment. And then system and delivery, how it is processed, how it is delivered to the customer. And then disposal, how do we dispose of the waste. Next, we have activity-based costing. Activity-based costing we just saw. So what we could do is apply the principles of activity-based costing and environmental costing, where we look at the cause of overheads because of cost drivers, and then try to reduce the total cost, just like we would try to reduce the cost in activity-based costing. Next is life cycle costing. Life cycle costing is looking at the cost of the product from development stage all the way to the disposal stage of the product, and the environmental cost. So we already know the principle. It is just looking at environmental specifically. So this is life cycle costing. Let's look at other 2 chapters that are in the start. Remember, they are all theoretical. Okay, so again, I will here just skim through the important stuff. Most of them we have studied in F2 or in F1. So most of it is just a revision of that. So it still needs detailed study. So I'll just scratch the surface of it. Okay, the first thing is information system. So information system involves all the software, the hardware, and everything that an organization has for collecting information. A financial accounting system is also an information system that produces budgets and stuff. Okay, remember there are 3 things that an organization does: planning, decision making, and control. Planning is looking forward, making way for the organization, setting directions of the organization. And control, remember, planning and control are used together. Control is correcting divergences from plan, and if anything goes against the plan, and bringing it back to the plan is control. Like planning is example would be budget, control example would be variance analysis, and then decision making is choosing between alternative. Remember, decision making role of management is ad hoc. It means it is done whenever it is required. But planning and control is done regularly, maybe annually, maybe monthly, depending on the size, the type of the plan and control. Okay, benefits of organization system. Okay, nowadays information is very important thing, because those organizations that have information, they have a competitive advantage. And also it is essential to get information quickly and then work on it faster, and then also use that information in the best way to develop a more competitive product than a more better product than your competitors. Okay, cost of information's direct data capture cost is the cost that you are incurring directly when you're capturing data, like using barcode system and stuff, and then processing information into computerized accounting and stuff, and then indirect cost of producing information. It is when you store information in a separate place and then you use it at a later date. Okay, how can information be shared? You know about networks, internet, so I will not waste my time here. So you just read them in details. Okay, internal source of information, remember, is information that we gather from within the organization. They could be primary or secondary information. Remember, primary information is something that is obtained for the first time, first-hand information, and then secondary information is second-hand information. This information could be gathered from our accounting system, our website, from the management information system, so within the organization. And then external source of information is something that is gathered from outside. Again, it can have a primary source and secondary source. Primary source is information that is gained for a specific purpose, and then secondary information is information already gathered and then it is used for another purpose. An example of it would be suppliers, internet. So all of these examples are given here. Okay, let's look at the other one. So yeah, they were just basic things. I believe you can do it. Remember, this is something you saw in F1. We have top level, middle level, and bottom level. The strategic level is the top level. They focus on the long term, and they are less detailed and more words. Operational level are the lowest level. There are more details and they cover shorter period. And then tactical information is in the middle. They are medium detailed and they cover medium source. And remember, strategic information is usually from external source, and operational information is from internal source, and tactical information is usually half internal and half external. Okay, then information could have a focus. They could be externally orientation, which means they are focused on the outside, like things outside organization, like we have customers, competitors, suppliers, other stakeholders that are not within the organization. They could be backward looking or they could be future looking. Future information is something that looks about the future, for example, making a decision that involves future. Goal congruence, you also saw in F1, which simply means goal of all people in the organization is the same as the goal of the organization. Okay, in strategic management accounting, what could you get? What information does it provide? The top level, remember, competitors' costs. So why do you want to know about the competitor costs? Because if you know about their costs, you would be able to know whether you can beat them or whether you cannot beat them. Financial effect of the competitor response. So if we change our price, what the competitor will do. Product profitability, getting information, strategic information will tell us whether our product will be profitable or not, which we could use in life cycle costing and stuff. Customer profitability, like having customer life cycle, customer loyalty. So we want to know whether the customer, having customer for a long time is profitable or not. We could use information for better pricing decision. You will study that in pricing chapter. The value of market share. Is it important to increase our capacity? You might have seen some organization, they can increase their capacity, but sometimes they don't want to because they believe that increased capacity is not going to be not as much worthy to them. Capacity expansion. Should we increase the capacity so that it is linked to the market value of market share? Brand values. Is it important to invest in brands, create brands? Shareholders' worth. Are we creating wealth for our shareholders? Remember, whichever decision we are making, the main focus should be increasing the wealth of the shareholder. Next, it gives us information about the cash flow of the organization. Remember, profit is cash flow is as much important as cash flow. It helps especially survive business in the short term. Effective acquisition and mergers. What if we buy another company? What if we combine with another company? What will happen? Should our decision to enter or leave market, which simply means should we enter in a particular market or should we exit from that market? Okay, information systems. Organizations can have information system within them. There are different types. One is transaction process system, which simply processes transactions like you would have QuickBooks accounting software. You input transactions in it, and it processes those transactions, make into reports and stuff. Management information system is a system with an organization. Whenever management need information, management accountant need information, they could access that system. They could be used for budgeting, decision making and stuff. Executive information system. There is an information system for the top level, and it is usually linked with the outside internet and stuff, so it can be used for long-term strategic plans. Enterprise resource planning system is a simply management accounting system which helps with management of the resources, like production resources and stuff. Customer relationship management system shows our relation with the customer, the product that they're selling, how long they have been our customer, so giving all the information about the customer. Cost versus benefit simply says that information, the benefit of information should be more than the cost that you are incurring on it, but usually you don't know whether information is going to be beneficial until you spend money on it to acquire it. Okay, this is it. So again, read them in detail. The next thing we will do is do questions on them. This whole section is finished, so we will do VPP questions.